Well, I think we try to look at ourselves as longer-term investors, so we're not trying to take advantage of the intraday moves, trying to have a vision for where we think things are going to move really over the next year, as opposed to the next day, over the next week. So from that point of view, our allocations actually are overweight equities. I think we want to keep in mind that equities still have done rather better than fixed income so far this year. So at this point, we're sticking with that allocation. Actually, we also have had and do have an overweight to the NASDAQ. So yes, we've had a, not quite a correction yet, but certainly a sell-off from numbers that were quite high. But if you step back and looked at where you are year to date and imagine that that had just been a straight line from January 1st to where we are today, actually, you'd be quite happy with those returns. So I think that's a perspective we want to keep.
Do you think Buffett saw this top? I mean, Berkshire Hathaway, the latest quarter, raising a lot of cash. Where do you think the cash should be deployed in the longer term investment that you guys do?
Well, I guess I'd have to refer again to our allocation. So besides having an allocation overweight, to the NASDAQ in the U.S., another one that I think is also important to keep in mind, given the global context that you mentioned, is actually also to gold. Gold has also been pretty resilient and done very well so far this year, has done relatively well recently, because that offsets, on one hand, still for us a positive outlook, a view for a soft landing, at least in the U.S. In the months ahead, but also recognizing the geopolitical concerns. Don't forget, we did have about inflation until recently. So I think that's another way to think about the outlook, trying to take advantage of the growth opportunities that we do think are there, but appreciating, as we've had recently, there's always that potential for unpleasant surprises.
Let's go back to the origin of these recession fears. Do you think soft landing is just off the table for now?
Oh, definitely not. I mean, let's remember at the beginning of the year, of course, we were questioning the soft landing narrative because inflation was too strong. Fortunately, we've had 2 months of really quite subdued inflation. There's probably more a question of whether or not it stays at that low level. But growth until now, of course, hadn't been a concern. The data recently clearly a bit more concerning, but we have to remember what the objective here is of a soft landing. That means that we needed to get to a lower rate of growth than we had been last year, than we were at the beginning of the year, without that without that slowdown going too far. But inevitably, that means on the margin, you have weaker data every month than you had previously. And essentially, that's exactly what we've had. So the weak payrolls number is not in and of itself a contradiction of the view that we're still heading for a soft landing. We do need slower growth. We're on that path. That's a good thing, because otherwise you were not going to get inflation back down to target.